and serves a nationwide network of financial professionals. Call 1-800-290-7226 or email thequest@brokersalliance.com. And remember, when you need financial guidance, call Brokers Alliance.
Well, welcome back to the Quest for Financial Freedom. I'm your host, Steve Savant, and with me, my co-host now, Eric Balmer. You can call us anytime, 1-800-290-7226. That's 1-800-290-7226. Or write us at our email address, thequest@brokersalliance.com. And this whole second segment, we're going to be talking about the most persecuted product of all time. Now, one of the reasons is because you got to remember, with any product, there can be sales abuse, client abuse, product abuse. I mean, and that goes without saying for any product. And in the earlier days, let's just say maybe everything wasn't done as it should have been. Maybe it wasn't the greatest idea. But the first product out on the street was whole life. And the reason they called it whole life was because you paid for your whole life. Yeah, i.e., you know. And so you paid for your whole life. And then they started coming out with this idea. And I remember the first United States mutual company was the Venerable New England, who I think was bought out by Metropolitan. Mm-hmm. And that was in 1835. That was the first mutual company. I think actually the first one in the United States, I think, was First Presbyterian sometime in the 1700s. So insurance in America has been around for a little while. I mean, this is something, and you know, way back when, in the day when Sir Edmund Halley actually drew up the first actuarial table, and Lloyd's of London, right, started to go outside their normal merchant insurance for their shipping, right? They started looking at life insurance and paying living benefits. I mean, wow. I mean, that's way back in the day. Right. That's 300 years old. When you look at what we're looking at today, whole life has been around for, I mean, like forever. And permanent insurance, this is the first chassis, mortality chassis, where they actually kind of measured a man and a woman's life expectancy and put a price tag on it. Right. But what really got strange was when they did such a good job of pricing, instead of starting all over again and reprice the product, they were giving back unused premium in a form of a dividend. Now there's a difference here, and maybe you need to talk about this for a second. There's dividends in a stock and bond. I know I pay cash for it. I have paid taxes on that. Right. But then there's this dividend that's really classified as a return of unused premium, which I get back free as long as it doesn't exceed my original contribution or basis. Right. Talk a little bit about that.
Yeah, the dividends come in a couple of different forms inside of a whole life contract. Cash dividends, you can take them. You can use the dividend buildup to actually pay for additional coverage inside the policy.
So if you took the dividend in cash, that's free?
Actually, there's taxation if you take the dividend in terms of cash.
Well, if I take my dividends in cash and it's a return of premium, I know ultimately I'm going to have to pay taxes on everything above the basis line, above what I originally. But for a little while there, I might get some free dough here.
It's possible. It depends on what that number actually comes out to be. And you talk to your. I was actually going to say, if talk to your tax advisor in terms of what that means for you personally. But if there was any gain on top of the amount that you originally paid, yes, it's going to be exposed to ordinary income
tax. And just
tax.
remember, when you can call your company today and ask for a thing called an in-force ledger. Right. And that in-force ledger will show you what you have and the dividends that are taxable or not taxable. And you were talking about cash. What's another way you could use your dividend?
The dividend actually could be distributed in the form of a partial premium payment. So if you were paying normally $1,000 a year for your whole life policy, the dividend could be applied, and you might actually only have to come out of pocket, maybe 80% of that.
So it could reduce the premium.
It could reduce your premium, exactly.
If the dividend payout was pretty good, it may actually pick up the whole premium sometime in the future.
It's possible. Some companies have paid extremely high dividends. Lately, we find that they're more levelized over the last 5 to 10 years, but it could certainly be covering that portion of that premium, or what we call a paid-up addition. You could actually be using those dividends to purchase additional coverage inside the policy. So you may have started at $100,000 of coverage, but with those dividends, you might have been purchasing some additional coverage internally, bringing your policy to, say, $150,000.
So if a carrier has done well and they're going to return a premium, you could say keep it, and whatever additional insurance it'll buy, go ahead and apply that to the policy without any insurability.
That's correct.
Wow. We'll talk a little bit about this other one. You could buy a term rider with it.
Yeah, you can buy a term rider. It essentially is, again, increasing some additional coverage for a set period of time. And those are they vary a little bit from carrier to carrier, but the idea is that you can put it to work in different ways. You don't have to just take it in the form of cash. It's not like a dividend, like you mentioned before, a stock dividend, where that comes to you no matter what, and you are paying tax on. You can apply it to enhance the buildup of your policy.
I'm also thinking about if I wanted to use this for income, I could actually take policy loans on the total cash value on top of the dividends, and I could actually loan myself some money.
That's one of the strategies that we actually look at most often today with whole life. Whole life is a great tool for, say, business owners. Especially, I'll give you an example. There's a lot of dentists out there that are using third-party companies to cover the crediting, if you will, of a consumer. So if somebody had a very expensive procedure done, they might not be able to pay it all up front. They're going to, in a sense, be using this third party to cover that cost. And those dentists have to pay a high margin for that third party company to be loaning, in a sense, the payments back to the dentist. So a whole life policy actually can do that very same thing. You use the dividend buildup in the cash value. A loan out of a life insurance policy is tax-free. In some instances, with whole life, it can be taxable, but again, we always say, talk to your tax professional. But that's cash out of your policy that you can reapply back into your business. And so it's kind of a recycling of premium, if you will, and we look at that quite often. It's a very common.
So you could actually use this like as a business sinking fund where you become your own bank.
Be your own banker.
Be your own
exactly
bank.
Right.
Well, when I'm thinking about the commitment, in the old days, the definition, again, remember, I've just stated this earlier in the segment. A dividend is a return of unused premium. Now, in the old days of the war against whole life, A.L. Williams, the famed termite, the person who only believed in term only, he always said that dividends were a return of overcharged premium. So, we're looking at this tale of two cities on definition. When I'm thinking about where to place this product in the bigger scheme of things, I've noticed that several carriers have come out with lockdown, guaranteed 10-pay scenarios, and you're done for life. 20-year pay scenarios, and you're done for life. And certain carriers are really actually pricing their product based on that because they understand that the consumer has kind of went a little bit on the kind of a rebuffed the whole life forever scene. And so can you give me something that I can manage to? It's 10 years and I'm done.
Right.
20 years and I'm done. Age 65, I'm done.
Or single premium, just one payment,
one time and
you've purchased up your insurance. One thing to keep in mind in those limited pay type structures, and we're creating a modified endowment contract, a MEC contract.
Or just on the shorter pay?
I think there's situations that I've seen where we can, play with the numbers a little bit to avoid the modified endowment. But typically, I see in the single pay premiums, especially, it's a MEC contract. And what that really means is that you just got to be careful with the distribution of the cash value. If you are taking some cash out of the policy, there could be some tax consequences, but the death benefit is still tax-free, and that's important.
Yeah, when you think about it, a modified endowment contract, which they changed the rules on us way back at 6/21/1988, seems like forever ago. When they changed that, now the life insurance in a single deposit for access to cash is pretty much treated, I would say majorly, like an annuity. It's on the same tax issues in the services addressed it similarly.
Right.
And so when I'm looking at it, and if I'm doing it for death benefit, maybe I don't care.
Right.
I'm just looking for the leverage of a single deposit, one pay, walk away. I don't want to deal with it ever again.
Right.
But if you needed access, then just to remember, hey, be aware, if you have gain in the contract, hopefully you do,
right.
Otherwise it's not a very good contract,
right.
You're going to have to pay ordinary, not capital gain, ordinary income tax on that money. And just got to be aware of that. But if it's truly for coverage, or the big word we use, indemnification, coverage or protection, then it really shouldn't really matter.
And the single premium contracts are used quite often, or the 10-pay contracts are used quite often for wealth transfer. So basically there's $100,000 on the side that you want to pass on to your beneficiaries. You don't have any major intention of using the money, but it's kind of nice to know that just in case you have access to some cash, single premium contracts work really well because, again, the death benefit, even if it's a modified endowment contract, is tax-free to those beneficiaries, and that's sort of the key point there with the wealth transfer.
I really enjoy looking at what I would call staggering accumulated numbers when you get a decent contract, a whole life contract that's paying a decent dividend, and that dividend goes out like on a platform of 35 to 55, somewhere in that vicinity, those years, when you start getting out in those late years, those dividends, talk about Einstein's theory of compounded interest, it really starts racking up the numbers, because the longer I hold the positions on these contracts, and if the dividend, the carrier is a blue chipper, you know, there's many blue chip carriers, I mean top of the line, high quality carriers, highly rated by all the rating services. Those contracts are huge, just enormous. Now, of course, remember, a dividend is not guaranteed.
Right.
You know, it's not guaranteed. They could keep all of the premium that you gave. Most carriers that we've seen thus far have been decently giving something back.
And we got to ask the question: is this whole life product participating or non-participating?
Yeah, because we've been talking about participating.
We're talking about participating. Non-participating, they're not paying a dividend.
Well, why would there be a reason to buy it then?
Cheap. It makes it cheaper. So the non-participating whole life contracts out there are lower premiums, a more level, like a levelized contract. You still have the cash value, but it's not. It doesn't cost as much to purchase that death benefit. And you kind of talked about it earlier, the theory where the dividend was the overcharged return. I think the idea there is just that if we remove that dividend feature, we can make those premiums a little bit lower.
Would it be competitive on a guaranteed universal life contract? Could you compare a non-par whole life contract to a guaranteed universal life contract?
You could. You're not going to see the cash value that you would see in the non-participating whole life contract, but you are going to potentially see lower premiums and maybe even higher death benefits. So we'll compare both.
And you show that in all your grid work.
Our spreadsheets are going to show you every option that we think is viable for the client, because you have to remember that a lot of our advisors are very much focused on certain things. They might know term insurance really well, and we always want to put it out there that there are some other options, and they might be a little bit better for these particular clients.
What I like about it is that you actually show multiple alternatives, whether it's term, 10, 20, 30, 40-year term. I can't hardly believe that. And then now we're looking at permanent contracts that go out to age 120. Is it whole life? Is it guaranteed universal life? Is it current assumption universal life? Is it indexing? We're going to talk about that tomorrow.
And I mentioned wealth transfer and some of those conceptual type ways to position or to show your clients the advantages to things like whole life. We have presentations that support all that. Just let me know what you need, and our team will get it to you.
Well, I want to thank you, Eric, for being on our show again today. We got a split. Our sponsor, Brokers Alliance in America, where anyone can go on a quest for financial freedom.